So please welcome David Cooper from Purdue Research Foundation, Antony Lewis from Temasek, Matt Halstead from Texas Teachers, Joe Marenda from Cambridge Associates, and Katherine Molnar, last but not least, Fairfax County Police Officers Retirement System. Welcome. So Cooper, if you can sit there. Thank you. Katherine, Matt, Antony, Joe. Good stuff. All right. As I said to people, like we had, when we programmed this thing, things were a little more upbeat in the crypto space. So, but we, as a good media organization, need to delve into news, good or bad. And so I want to lead with, the news of Terra, and that's T-E-R-R-A, not O-R, although some might interpret it that way. The collapse of the stablecoin, Joe, I thought just like maybe you could weigh in. Like, what does this mean for this space now? I mean, does it challenge? We were reaching a point where I think investment community was starting to take this stuff seriously, understand we are here. This is an established thing now. Does this challenge that? What's your takeaway from the UST collapse?
I think a couple of years ago, this would have been a big hit. I have not gotten any pushback. It's more questions about like, what was it, how did it happen, why did it happen, those types of sort of mechanical questions from investors. And so I think from an institutional perspective, it's more of a learning point. And this is the first opportunity that the people up here and people in the audience have had to evaluate the way funds manage risk. It was widely held across venture funds and hedge funds. And some of them handled it brilliantly and others failed miserably at it. And so we now have a real data point where we can say, look, we're paying you an enormous sum of money and you're not risk managing, or you managed risk brilliantly. So this has been a fantastic learning opportunity for institutional investors to be able to actually have a data point to talk about funds and the way that they built their portfolio with the selected positions and the way they exited or failed to exit a position.
Matt, you guys are relatively new in this space. So you invested, when was your first investment in crypto?
Last fall.
Last fall, okay. So with this latest event and also the turmoil in markets generally, what's been the impact? Is there any pushback from people in your organization? What's the...
No, I think people understand. We spend a lot of time on education. I think expectedly to just help people understand the risks, help understand, like, this is still very early stage, just broadly speaking, and things are going to break. There's going to have an enormous amount of volatility, but long term, we think this is something that's going to be major in our portfolio, and so I think most institutions at this point are eyes wide open that there will be issues. It's going to be difficult to predict what those issues will be specifically, and while this one was significant, zero impact in terms of what we're doing.
Okay. And Katherine, you've been through this for a while. Now, how long has Fairfax been invested in the space?
We've been invested for about 4 years now, and we've made 9 investments, most of those in venture capital, and then more recently a long and short hedge fund, and then very recently 2 yield farming funds.
Okay, so you've actually been through, kind of a bear market. Like, you started in the midst of a bear market from the sounds of it. So what is your advice, having seen this experience now for 4 years to investors?
I think periodically you need these types of market movements to kind of clean house. I'm not saying that you need necessarily something on the magnitude of what happened with the UST Terra Luna debacle, where $60 billion in market value was lost in a matter of a few days. But in general, I think that we've seen valuations get very lofty, and which we benefited from. But nonetheless, I think just in general, just the same with a tech boom and bust. It's a chance to reset. For those managers where we've committed capital and they haven't yet deployed it, it's a great entry point naturally. And I just think these things tend to be healthy. And then the technologies that really have a lot of the technologies that are really strong will still have mass adoption, and those that maybe there was nothing to begin with will go away. So it's healthy, I think, for the space.
And Coop, you've got an interesting responsibility at Purdue. It's like you're managing the endowment, but you also have this sort of research compulsion as well. And when you and I talked, you talked about the importance of being innovative. How are you viewing that? You know, you've got these two competing demands almost.
Absolutely. We're you know, as a research foundation and the nonprofit entity supporting Purdue University, a great STEM school, we want to go through the progression of learning as much as we can about this to see if it makes sense in the portfolio, and if so, in what form. We've been fortunate thus far in that we've had our exposure organically, not through a dedicated VC partners, but some of our existing VC funds that have had exposure into the crypto space, blockchain technology that's worked out really well for us. So as we're learning more about the space and getting up to speed, it's been nice that we've had established VC managers that we trust who have already allowed us to have some exposure organically.
But none of this is smooth sailing. Surely there is enormous resistance from certain quarters within your various constituencies. And Temasek has a very large and important constituency, that's the Singaporean people. So it's a sovereign wealth fund and historically quite conservative investing organizations. What's the lesson you've taken, Antony? You've been in this space for quite a while, and I don't know how long you've been at Temasek for, but you've had to bring them, I take it, on a learning curve.
Yeah, no, thank you. I've been at Temasek for a couple of years now. We've been investors since 2019, firstly in venture funds and then direct investments too. As an optimist, I'd like to take away the positives of the terror incident. There are a lot of negatives, which has been widely covered. In terms of the positives, it really shone a light into stablecoins. So I found myself doing a lot of explaining. And when you explain to people what happened with terror, you have to start talking about Anchor. Then you start talking about DeFi. You start explaining what DeFi borrowing and lending, how it operates, how it works. You're lending to a smart contract and you're borrowing from a smart contract, and all these new concepts. So it was cool that there's this spotlight on this incident, because it really draws out those mechanisms there. So on the one hand, it sucked for a lot of people, and people lost a lot of money. On the other hand, there's great learning from it. The other thing is, at a wider level, I guess, it shone a spotlight on stablecoins in general. So it's accelerated those questions around stablecoins: which should exist, which shouldn't, how should they operate. So I feel like it's kind of accelerated all of those conversations, both internally and at a global scale.
And how are those internal conversations going? Like, so the board is supportive? Do you find, is there pushback? And if there is, how do you deal with that?
Our board has been generally supportive of our crypto investing. It's only a small proportion of our balance sheet right now. I hope it grows. But eventually, I think that a lot of companies will use public blockchains in different ways. So instead of, when I first joined the organization, we saw crypto as a kind of industry or a vertical. Now we see it as more of a horizontal enabler for more and more companies. Like, just as more and more companies use the internet by having websites and then developing e-commerce, I think we'll see more and more normal non-crypto companies use public blockchains in different ways in the future.
Katherine, maybe this question of how you deal with a board and how you get them to get comfortable with this. Maybe you can tell us a little bit about your journey and what sort of educational exercises you had to go through and what level of resistance there was and how you eventually got them over the hump.
Sure. So we embarked on this about 4 years ago in 2018, and investment staff wasn't super familiar with blockchain technology or Bitcoin, and certainly our boards of trustees, for the most part, were not either. So, as staff, we spent a lot of time trying to inform ourselves and educate ourselves. And then when we went on site with the manager that we ultimately hired, so to do our on-site due diligence, of course the investment team went. That's quite normal, naturally, but we also took members of our boards of trustees. So we have 3 different boards of trustees, as we have 3 different retirement systems, and we took senior members of each of those boards of trustees with us on site to see the manager. We took our executive director of the retirement agency. We took people from operations who were there remotely. And so they were on site with staff the whole time that we were there for 4 hours in the manager's office. And again, that's quite unusual for us to do that. But it went a long way, because then when the manager came to present to them, there were a few people in the room who had heard that message directly. And so that helped. I would tell you, though, that there were still issues of money laundering, especially given I manage money for police officers. You know, there were just, you know, concerns of exchanges being hacked and that type of thing. But we really tried to underscore, certainly for the venture capital investments, that it's just a growth opportunity. It's a growth opportunity. It was sized as being speculative, but, you know, all venture capital is speculative, right? So we were very upfront about, you know, about that it's a new space. We're going to size it appropriately. In my portfolio, we started initially with just a 50 basis point position, so not huge, although now it's done very well, so it's worth a lot more than that. But again, we marketed it as a growth investment, blockchain technology. We were really trying to invest in the infrastructure that supports the technology. We were not trying to make a bet on a specific token. We're still not trying to make a bet on a specific token. And so, you know, we just said that this is part of an innovation theme. That innovation theme is blockchain technology. There's life sciences. There's artificial intelligence. There's cyber and national security technologies, electric vehicles. So it's just one of, you know, of those, you know, it's a growth investment. And we just stuck to that, and obviously it passed.
So that idea of you know, investing in the technology of the future, the underlying infrastructure, I think is a really interesting one, and you know, one that I think is consistent with a lot of the stuff we want to explore here today, with this sort of what this Web3 future looks like, and thinking about it in those terms. Joe, what do you advise in that regard? I mean, do you this idea of building a portfolio, growth focused, strategically on this future? What do you see as the best strategy?
In terms of implementation, or just sort of broadly speaking within institutional portfolios?
Yeah, within institutional portfolios, yeah.
So for anybody who's trying to get this past a board or a committee, if you go immediately to technological change, disruption, disintermediation, creation of new business opportunities, you will have a much easier time than if you actually try to explain it. And so don't try. I've never had anybody ask me how TCP/IP works, but I've had lots of people ask me how Ethereum works. And so you're at that level of education. But if you explain to them how technology change has been so disruptive over the last 30 years, they can immediately grasp what the potential is for something as potentially revolutionary as blockchain. And you need to remind them of things that they didn't really roll forward. So remind them the first time they got an email, did they really think their lives would be dominated by email and chat? The first time they bought a book on Amazon, did they really think that they'd be ordering food and all these other things? So once you sort of roll this back to things that they actually experienced firsthand, you have a much easier time moving this forward, because they suddenly realize that, yeah, humans are probably pretty bad at predicting futures, especially long futures, like 30 years out. Back when we were all, well, for those of you who are around, who were you know, working with like AOL Instant Messenger in the 1990s, no one thought of TikTok. So you can bring up all sorts of things that way. And I think that's the same conversation you have, to bring it back to your real question, about the metaverse and Web3. It's very much the same thing. There's like, we don't know what things are going to look like in 10 years or 20 years or 30 years, but we can roll forward our past experiences and realize that this is something that could potentially be immensely disruptive to their existing portfolio. And all of investing comes down to two things: fear and greed. Fear that I'm going to lose what I've got, and then the greed is I'm going to make a lot of money off of this. And so the minute you kind of frame it in the context of this is a threat to your existing portfolio, and all the technology, media, telecom that you have in your venture and growth hedge funds and all that kind of stuff, you have a much easier time rolling forward without having to say, this is what's going to happen in 5 years, because we don't know what's going to happen in 2 years in blockchain.
Right. Antony, Temasek, how do you view that strategic play? I mean, are you placing bets on which metaverse company is going to win and which underlying layer 2 is going to solve scalability, et cetera, et cetera?
So not quite yet. I think, like everyone else, we'll focus on infrastructure, because if the industry succeeds, the infrastructure will succeed. And then you can focus on apps a little bit later, because when AOL's around, you can't invest in the TikTok. It doesn't exist yet. You need various elements to be in place and be working successfully before you can build on top of that. So I think these things come with time. Internally, we've been building capability to hold, I call it hold one ETH. If we're able to institutionally hold one ETH, I mean, I tried suggesting I can hold it on my MetaMask, but
doesn't sound like a particularly
that didn't really fly.
This is one of the biggest sovereign wealth funds in the world. You've got one ETH. Well done.
So, but once you can hold one ETH, you can hold 100,000 ETH, right? So it's building that capability to hold, account for, pay tax on and deal with one token. And then once you've got that sussed, then you can do NFTs, you can do whatever you want.
Yeah.
But that's
like an
been
MVP almost, right? It's like an MVP, just the you know.
yeah, just hold on ETH.
Yeah,
Just hold on
exactly.
ETH.
I like it. We'll use that.
Yeah.
Matt, look, shifting gears a little bit here, I want to think about the constituents, right? The members of your fund, and they have a varying ages, I would imagine. I went to schools where some teachers were quite young and some were quite old, and
Still the case.
you know, investing horizon is very different for those people. Their digital readiness is quite different. How do you balance that? And what are you hearing from members? Do you get a generational divide as to whether or not they want to be invested in this space?
That's really not how we're organized. You know, they've trusted us that we've built I think we've built a great professional team to deliver the retirement that they've been promised. And just like we don't tell them how to teach our kids, they don't tell us how to protect their investment. So, you know, we've got a great board, we've got a great team, and I think have developed a excellent working relationship with our members. And it really doesn't go beyond that.
Well, let me phrase it a different way then. I think it's just more, again, as I said, there's a very different investment horizon.
Yep.
If I am coming out, I've had 0% interest rates for ages, and I'm trying to predict 30, 40 years on,
Yep.
you know, I have to think differently about what kind of assets and what opportunities exist, right? A bond that is earning 0 isn't going to get me much in 30 years' time. Do you calibrate that, I suppose, is where I'd like to go.
Yeah, I mean, I guess what I would say is we believe that one of the major themes in the world today is, you know, it's an increasingly digital world, and that people will spend more of their time, you know, at work, you know, socially, at leisure, in the digital world. And so how do we organize ourselves as a fund, one of the biggest investment funds in the world, you know, with a member, you know, who has a typical liability, you know, 25 to 30 years? Like, how do we organize ourselves at scale to participate? And so we think, you know, blockchain, Web3, crypto, whatever you want to call it, will be a major component of that. It's not the only component of that, but I think anyone that's running a fund or just investing for their future has to be aware of that theme. I think another big theme is, you know, users and creators participating in value in a way that really hasn't been possible without the technology we're all investing in here today. Those are two major themes that I think any portfolio has to be organized around. I think just at a very simple level, that's something that we believe in, and that's how we're building our business to help fund, you know, and invest in that growth.
Coop, how about you guys? I mean, looking at, again, the constituency, a very different constituency, university, endowment, research responsibility. You know, how do you address, what are the big themes that are dictating, you know, how you resolve that?
Yeah, I think we want to leverage the university and their expertise in this area as well. But I think Joe hit on it earlier, and that's if you can connect utility to your audience, it makes a big difference. So is there something about utility that's going to impact their lives either personally or their business that's going to increase revenue, decrease expenses, you know, increase the bottom line in a way that would not have been possible without blockchain technology or Web3? And so, again, we're just, you know, going down this path, learning as much as we can. And I think the other thing, connecting utility, is just a reminder to boards, committees, that we all already have exposure in blockchain technology in the portfolio. If you have Tesla, right, you have Bitcoin. So I think those things can kind of help the argument as you're educating yourselves and your committees alike.
Speaking of committees, there's now such a thing as the ESG Committee that is prominent on the boards of a lot of investment funds. And, you know, another raging debate out there about whether or not cryptocurrencies are, you know, hugely harmful to the environment, and whether different protocols are or aren't in terms of the consensus algorithms. What's happening in this space, Joe? Like, what is the current state of conversation within the investment community around this, and, you know, best practices and so forth?
So I got this question because we have an entire group dedicated to ESG. So, and all of our clients are very sensitive given that we have a lot of endowments and foundations and pension clients. So this is a question that we get all the time. What's fascinating is the E dominates the conversation. And there is no discussion about S and G. And S and G in blockchain and crypto is immensely powerful and so much better than what we've got now that we actually have to elevate that portion of the conversation because it is not simply E, it is all three of them together. And so, E, it's easy to write really big headlines, more electricity than Denmark or something like that, right? So, always the first question I ask them is, well, how much electricity do data centers consume worldwide? No one knows the answer. I'm like, well, at least you can calculate it for Bitcoin. Then this, like gold. No, actually you have to store it. You have to have employees who keep it safe. They drive back and forth. So there's so many metrics that are not equated, and it's not an equal stance, but there's this headline that you can write that is always dramatic. And so the headlines are always the things that we're having to answer. And so the conversation around S and G, though, is very dramatic. I mean, in the case of governance, for example, there are no dual share classes. Anybody who's an owner can make a proposal, and everybody can vote on it. And it's whatever the white paper said, whatever the majority is, wins. Good luck getting that through. I'm not going to name any companies. Good luck getting that through some of the tech companies with dual share class voting structures, where it doesn't matter what everybody wants, because whoever has the supermajority shares is just like, yeah, no, I'm not going to do that. So the G is dramatically different. It is far more inclusive. It's far more equitable. And the S, if you think about it from the global context, and one of the challenges that everybody has is they typically are thinking about their lives as opposed to the globe. And so if you think about somebody living in a developing country who is unbanked, DeFi and Web3 and all this fundamentally changes their lives. And suddenly borrowing and lending, which is something that may not be able to do in those countries, they get the same rates as the hedge fund titan on Wall Street. And so the S actually is also very, very powerful, but we actually have to create reasons for and better explanations about why each of these is really powerful. And then you can sort of balance out the E, because the E will dominate every conversation, when actually, if you think about it from a global perspective, the S and the G will fundamentally change, or have the potential to fundamentally change a lot of people's lives.
Yeah, I don't think the industry should engage on this topic in general. I think it's just it's a trap. I think once you start deciding what is and is not a noble use of electricity, who's the arbiter of that? I think that's just a fight people shouldn't engage on. I think as an industry, what we should focus on is what are the best practices that we can all set that will determine the trajectory of the impact of blockchain, which is I think a profound and transformative tech. I think, for example, like custody is one of the biggest issues that we should all be talking about. Engaging with our partners, engaging with builders, engaging with investors, because I think, many of these digital assets are designed to be engaging and active. And I think the default for institutions with legacy asset classes is to store them. And I think that's toxic, and I think it limits the potential of what we're trying to build here. So I think something that we should all challenge ourselves to do is to work together to set this default. I think with respect to custody, for example, we need to think about how can we use smart contracts to have our assets engaged in the ecosystem, participating in the community. I think you're going to see institutions gravitate towards social applications and NFTs in ways that are still more frontier, but I don't think it's that far off. And I think groups like Texas Teachers will be having to think about how do we delegate? Who are the right groups we work with? How do we work with the custodians that are out there today to understand what we're trying to accomplish and build the right framework for this industry? Because I think there are a range of outcomes here that are all positive. They're all improvements upon the existing system, but the distribution of that's quite wide. And some of these subjects with respect to governance and operations, I think, are very relevant. And I think all of us here today have the ability to shape that in a way that's very positive.
Really glad you raised that. I mean, that's always been this interesting dichotomy. I started covering crypto early on, and it was always the retail story, and the story, as Antony, who's been as long as I have, knows, is always, not your coins, not your custody, not your coins, right? And to suddenly see Wall Street come in and say, we're going to build all these custodians that are going to look after your coins for us, seems to defeat the purpose. But there's now a lot of really powerful technologies that are allowing a lot of the flexibility that come with, and the security to be able to execute and maintain control. So what's happening in this space? What are the developments in terms of custody, and is there traction? Are people taking up this call to arms that Matt's calling out for here.
So when we did this exercise, there was a fork in the road where we had to choose between managing our own keys and using third-party software solutions to create and manage our own keys versus using a custodian. Where we landed was using a custodian just because of the way we process things internally, organizationally. We're just more used to dealing with a custodian. Going forwards, could I imagine that we manage our own keys? Absolutely, yes. But taking it step by step, it's sometimes hard to jump to the answer. You have to, go through this process, like walk, get comfortable walking, then you can run, et cetera, et cetera. So I think there are great solutions being built out both on the third-party qualified custodian side and on the managing your own private key side that are ish institutionally ready. They'll say they're institutionally ready, but it depends on the institution they're facing. I mean, they might be crypto institution ready, but for organizations like ours, we're a lot more demanding. One of the longest parts on the project Gantt chart of holding one ETH was the legal docs between us and a potential custodian. Just making sure that all the risks that we're used to being covered and all the liabilities are in the right place. They don't really exist in crypto at the moment. So there's still a lot of legal wrangling with the custodians right now. But that'll mature with time, and we can see even through this whole 7-month process, the service offerings are improving very, very quickly indeed.
Katherine, what about you guys? Are you looking to self-custody solutions? And I'm really interested to dive into these compliance and regulatory hurdles that you have to get over to do so.
Yeah, so to be really clear, that the investments that we made are all through fund managers,
Right.
so we do not ourselves trade tokens. We have a 4-person research team, and I would tell you that none of us at the moment have that kind of backgrounds. I'm sure plenty of you could help us with that, but at the moment we're completely allocating to external managers. I mean, what I would also say though is, 4 years ago when we were embarking on this, the custodians that are very well known today, they weren't familiar organizations to us at all. And you didn't have Fidelity Digital or BNY Mellon or State Street at the time being willing to custody, and of course those organizations do now, and those are all kind of well-known institutions. But I think there's a lot of really good ones that just weren't particularly familiar, and so that was kind of something to be able to get comfortable with those service providers, if you will. Also, the concept that managers have to self-custody the tokens for a certain portion of time. So as an allocator, being able to get comfortable that the manager has the security protocols in place, indeed, to be able to self-custody those tokens. And then, as we all know, then at a certain point, those tokens can be moved to an external custodian. But what we discovered with 2 of our managers was that they owned their custodian, 2 different organizations, and they owned their custodian in both cases, right? So it was one of their portfolio companies from a prior fund. So there's a lot of kind of intertwinings here, if you will. But in general, we tried to be open-minded about all of that and not just nick somebody. I mean, in any other investment, I can't fathom investing with a manager that owns their own service provider. I mean, just the inherent conflict of interest there is just massive. But in this case, we wanted to be more flexible to be able to actually get into the space. So.
Could I push a little bit on this? Because I think at some stage you will want to or need to hold tokens, either because you have conviction in a particular token, or because you've invested into a venture fund and they want to distribute in kind instead of you instructing them just to dump it all on Uniswap and give you the USDC or something like that, or flip it into fiat before returning it to you. So we're preparing for a world where we will get distributions in kind from the venture funds, or having conviction in particular tokens. So I see that as a kind of near to medium future. What do you guys think?
Joe's thoughts as well, because
It's already happened. I mean, we've had multiple funds have distributed Bitcoin, ETH, and then most recently Solana. So anybody who has, especially a crypto native venture fund, but 2 of those, actually all 3 of those were distributed by traditional venture funds. So, and big names. So if you don't have some plan to put a custodian in place, you're going to get caught flat-footed. And it takes a long time actually to get these things set up. So that's a real challenge, and everybody needs to be prepared for it. The other issue, though, that's absolutely out there is the auditors. And that was one of the biggest impediments to owning this stuff directly a few years ago, is you were going to probably get an audit flag, and nobody wants an audit flag. And so we had to get the auditors it's like this food chain, and everybody in the food chain has to agree that you could actually do this, because not one of us up here wants to get an audit flag. And so I think we're finally at the point now where at least crypto custodians aren't going to generate an audit flag. It'll be interesting to see what happens when people start owning tokens directly, how the auditors deal with it.
You know, I keep thinking about you and your research mandate and the STEM responsibilities, and there's a lot of talk always that the way to really learn and develop and actually innovate as well in crypto is to get this, ownership, this control. That's when you start to build interesting things. And if you're just handing it off to a custodian to look after, you're not getting that capacity to grow and learn. And given that you have this sort of science directive almost, how are you thinking about these things?
Yeah, I think, again, it's early for us, but I think it's very possible at some point we do get to that. I think the space is moving very fast. I remember having conversations about custodians just 18, 24 months with them ago that weren't really thinking about this, and I said, well, you will, you might as well go ahead and, in 6 months you will. So things are moving very, very fast, and But again, we want to be judicious about the way we go about it, be thoughtful, and be prudent. But we're getting up to speed as fast as we can and learning as much as we can.
We'll get started early. It's taken us 7 months and counting. I think we're a few weeks away.
They've got more than one ETH now too, apparently.
I think that's important. Like, we should be participants. Like, the meme of the institutions are coming on crypto Twitter has always been more about, I think, some perceived legitimacy or capital, market stability, which there's something to it. But I think what we all need to be doing are participating, providing liquidity to these networks, actively engaging, building out, on-chain functionality within our businesses. I think that's really, it's a complementary, but I think essential part of any investment strategy. Because if you believe in this from an investment perspective, you're going to be creating value for your investments by getting involved. So I don't think it makes a whole lot of sense to sit passive long term in this business, and that is a change. Like, our equity holdings, our alternative investments in the past really didn't require that. So it's really interesting, and I think institutions, ourselves included, are trying to think through, all right, what are the different ways we can...
You have to focus on those proxy voting slips for once,
That's right. I mean, it's a whole new world in many ways, which is exciting and it's challenging, and we're at the very early stages of figuring it out.
One of the words that keeps coming up is compliance and auditing, right? This seems to be, and you can just see how it's a natural barrier, because there's all these laws and rules and regulations that have been in place. You must do this way because that's the way the world is. And as I've always said, this technology is a square peg being jammed into a round hole. So what's happening there? Is there a shift in compliance, or are you just trying to have to jury-rig new ideas around the existing rules? Joe?
I'm seeing a shift, but it's largely the result of education and making everybody comfortable. It's usually just no one has any idea what this is. And so education, step one. The good news is that in a free market, you have one auditor or one compliance entity that's really into it. And then everyone's like, oh crap, we need to do something about that. And so suddenly the competition factor kicks in. So everybody's building out a crypto practice. And it's in law firms, and it's in the auditors. And so in the end, I think we're going to get to a place, but it is going to take a long time to get through the entire process. But it is very much, we're breaking things to make new things. And if you think about what those other businesses I just mentioned, what they like rules, they like processes, they don't like change. They want things to be A, B, C, D, E, and then you end up at F. And so that's the challenge, is that no, sometimes you go from A to Z, and that's just the way it is. And so I think you are also going to have to see some cultural shifts in the way that those organizations operate and the way that they approach blockchain. But as long as one of them is pushing at it and winning business, the others are going to have to respond to that, and they'll have to get educated, and they're going to have to do something because there's enough capital now where they can't be ignoring it.
Katherine, what are you hearing from the compliance officers, and is there a journey they've been on, and what does that look like?
So we use we have a due diligence consultant that does all of our due diligence for us, so I haven't engaged directly on that topic.
So there's compliance with the laws, with the regulations. There's compliance in gray spaces where the regulations don't provide for these types of assets. And then there's compliance with your own internal processes where over a period of time you've learned how to do things in a safe way, the investment process and the managing those investments. And you've got your own internal processes, and getting them to understand and change and say, well, in crypto, here's the analogy, but it's slightly different. That's one of the key points as well. So it's not just like external compliance with regulations, it's also how do you change the internal mindset. I remember on one of our project calls, we had 50 people dial in, and on the first project call, one of the questions was, isn't this whole thing a scam for money laundering? So we had to take, the education journey started was, isn't this whole thing a scam and for money laundering? And we've had to bring all the different departments, legal and reg, accounting, tax, finance, all of those departments, bring them along this journey to get to the point where you can hold 1 ETH, and then you hold 1 ETH, and then maybe you stake 1 ETH, and then you participate in some governance, but one step at a time. But there's internal compliance and process change as well as the external stuff, which is also changing very, very, very rapidly and clarifying as we speak.
Well, yeah, I found our team very keen to participate and get involved, and it's been constructive. I think there's always apprehension up front, because there's a lot of just bad information out there in public. Like most of what you read in the news is just factually incorrect.
Apart from what Michael writes.
Yeah, of course.
Thank you, Antony.
But no, like we've spent a lot of time with lawyers and compliance folks, and they're really an integral part of our team. And I found them very, very engaged. And if you think about it from their perspective, it's something that's new, which is exciting. And so I think approaching it as a partnership is really the only sane way to go about it. And I think a lot of the investment firms in the space, by definition, are emerging managers and have little background or experience in these fields. And so, like, if you view it as consulting that we're paying for as your client, which, by the way, is how you should view it, you're getting a really critical part of your business supported by people who've been doing it for a long time.
Antony mentioned the external factors and what they're doing here. One of the major ones is this rather uncertain macro environment, right? We're in an inflationary period, the first time we've really seen anything like this for 3 decades. We've got geopolitical concerns. We've got, potentially people talking about the Bretton Woods system being broken up by this rupture that we're seeing between the West and East here. Does that feed at all into the way people in this industry are talking about investment opportunities? I mean, clearly that's part of the Bitcoin narrative to some of it, right? But Bitcoin, of course, is not looking at the moment, at least, to be as uncorrelated asset as it would have been in a hedge against inflation. But a longer-term perspective will give you a very different view. Joe, what's the current advisory position on this for investors?
As you said, like we have not faced this. By the way, if you live in an emerging market with inflation, this is not inflation. Just
right.
So like, it is inflation to us, but it is not, in a broader context. But it is dramatic. I think that the narrative is there are very few perfect inflation hedges. I mean, inflation tips are probably like about the closest you can get. Inflation protected bonds. Otherwise, the betas are not great. So the question that everybody has is, well, what is an inflation hedge? And there's no great answers for that because we haven't really had inflation to experience it. So the answer for a lot of folks is, what do you want to be invested in? Something that is disruptive and that is building a future that is not subject to inflation. I mean, the efficiencies of these blockchain-based businesses are extraordinary. I mean, you think about like Uniswap, I think they've raised like less than 15 million, 53 employees, half of whatever it is, $500 billion of total transaction volume on $15 million. So what do you want to be invested in? Do you want to be invested in things that have enormous potential to scale globally on relatively low capital bases? Or do you want to be invested in sort of old world existing businesses that are highly subject to inflationary and wage pressures? And so I think that's one of the easiest ways to think about this is like the stresses that existing businesses are going to be facing is manifest, and they've never faced them before. Most management teams, unless they're like in their 80s, never managed through inflation. Most investment teams, quite frankly, probably haven't been together since the global, maybe the GFC was their first crisis. So, everybody's untested in this. And so I think if you think about it from the context of this potentially highly disruptive future technology that is incredibly capital efficient, that's much more of an inflation investment opportunity than sort of what they're facing, what they've invested in today.
Yeah, using growth to beat inflation.
Yeah,
in a way, right?
yeah. Otherwise, I mean, what you can do tips and get whatever 9% or something.
It's interesting. Yeah, that's a very different perspective, and it's I think probably a pretty valuable one. It's also a good way I think maybe just to round this out here because when we talk about growth and this disruptive potential and everything else, it's that future state that we're thinking about, right? And so I'd just love to hear from all of you, like, what do you see the future? What you don't need to give me a big sort of futurist take here, but what is it that excites you about the kind of world that's coming as a result of this technology? Coop, why don't you lead off?
To me, it's the people, the mass amount of transformation that's occurred from traditional VCs, everybody is just attracted an enormous amount of talent, and so I'm not smart enough to know exactly what that's going to lead to, but look in this room, right? It's here to stay, and so how that's going to change our lives is I think specifically unpredictable, but I think it's definitely going to change them, and so yeah, it's exciting.
Katherine?
I think I'm constructive on all of it, obviously, but I think in particular NFTs and the metaverse and their application, and I've made this point on a few different panels, but we could probably maybe even all debate that maybe DeFi, will be probably used by everyone in this room, but nonetheless probably maybe somewhat a narrow portion of the population, whereas the metaverse is going to, I think, be pervasive, and everybody is going to be a part of that, and I think it's going to influence how we buy, how we consume, and we're going to all have more tokens than we know what to do with, and some of them are going to have value and some of them aren't, but I just think there's all types of really interesting implications from that.
What grabbed your attention in all this, Matt?
I think one of the most exciting things for me is this unlocks the potential to invest in the entire world. I think traditionally it's been challenging for a U.S. plan to take certainly private equity exposure in many segments of the world, in Africa and India and Asia. Some of that has to do with contract law, some of that has to do with liquidity, some of that has to do with currency. But if you think about the potential of what we have here today, it's the ability for smart contracts to unlock all of that. And we're talking about areas where their demographics make sense, where there's growth, where there are billions of people that have been largely untapped by big funds like ours. I think that's a profound unlock. And I also think talent is, pretty clearly normally distributed by geography. There's no reason to think that there isn't profound amounts of talent in Latin America and Africa and Asia. But it's been tough to identify, educate, and train that talent. And I think we now have the tool and the technology to do it in a way that will result in incredible investment opportunities, incredible growth, and prosperity for these areas of the world. And I think that's fairly new, and I'm extremely excited about it.
Antony, I want to go to something very specific with you. I read some stuff that you wrote about programmable money that was really impressive. And it was, so I'd like you to be able to explain to people what that is. What are the conditions that dictate what is programmable money, and why that's exciting, why that's important, and can we get there with CBDCs, with stablecoins, with because that's we had this conversation just before this. That's the other piece of this, right? Our money is changing as well. What does all that mean?
Gosh, thank you. That was a while ago.
Programmable
money. This is the idea that you can create money that is constrained in certain ways, that is used for a special purpose. Whether that underlying money is a unit of USDC or Ether or Bitcoin or whatever, but being able to wrap the money with rules, smart contracts, that say like you can only do this with this money. In the offline world, we have vouchers. Like a book voucher is $10, but you can only spend that $10 in a bookshop. That's kind of programmable. That's physical money that's kind of been programmed with these constraints. If you can do that to a certain extent with CBDCs, perhaps, depending on how they're implemented. But with money recorded on public blockchain infrastructure, anyone can program those constraints however they want for use for their particular communities, which I think is the first time it's happened. So with public blockchain infrastructure provides for the next iteration of the internet. And it's never happened before where you've had a ledger, some records, and compute, so smart contracts, that is outside of the control of specific companies who can rug you if they want, either because someone's put a gun to their head or because they've just decided they don't like you. That is new, and we're not going to rewind time. This is a new thing, and this will create tremendous opportunities as to what you're saying earlier.
On that note, Joe, take us home.
Yeah, I think the thing that attracted me is like when I first ran into blockchain in 2013 or 14, it was about this potential to reorder the relationships amongst people and also the relationships with corporate companies and corporations to create a more fair, equitable relationship, as opposed to simply, rent takers. That everybody who was a participant got something out of it. And to me, it was that potential on a global basis that was really exciting to me, that we could actually see a more fair, equitable, potentially a more inclusive world than what we have today. And I just rolled it forward. I thought, wow, that would be something that I think everybody here is really excited about. So I want to spend the next 15 years of my life. I think everybody in the room is about this. It's about that potential, not about sort of like, well, how can we make a buck today?
Great stuff. All right, well, thank you, all of you. A round of applause. This is a tremendous panel. Thank you, guys.